Let's dive deeper into those earnings results we just got a few moments ago from Netflix. Joining us now, Mark Mahaney from Evercore ISI. Mark, it's great to have you on. You're very bullish on the stock. You have been for a while. Your reaction?
They needed to put up a beat and raise quarter, and they did. Was it enough? Revenue growth organically actually accelerated. Margins are up year over year. So if you're a bull on Netflix, you're happy with what you got. But I'm not sure there's a reason to aggressively buy the stock right here. You know, it's a small buy for us. With the stock's trading at a 40 PE multiple, it's at the upper end of its valuation range. Look, everybody expected good results because of Squid Games. You got Stranger Things coming up Wednesday. So the content is all there. The margins are, you're getting the margin trends you want. But the question is, what else is going to be new? So what they need to talk about is how advertising revenue is ramping up. And what they need to talk about is live sports, live events, how we're going to see more of that content on the network. I think you will. I think those are your two big bull characteristics or bull drivers going forwards. But this is a decent print. It's a very good print. This is largely as expected. It doesn't strike me as there's something dramatic to do either way on the stock right here.
Well, I'm glad you brought up the ad piece of this because we have some more details from Julia Borst, and we're going to go to her right now for more from this Netflix report. Julia.
Hey, Morgan. Yeah, some color here on subscriber numbers. Now, Netflix has not reported subscriber numbers either the first or second quarter this year. They stopped reporting those subscriber numbers at the end of last year. But they say in this report here that member growth was ahead of our forecast, saying this occurred late in the quarter, limiting the impact on Q2 revenue. Also, just want to point out here, Q2 operating margin was well ahead of expectations, 34.1% versus 32.9% expected. Also forecasting higher margins in the third quarter of 31.5% ahead of the 30.8%. That was a street account estimate. Another thing to note here, as the revenue was just a hair ahead of expectations, but the company increased its revenue forecast for the year, saying this reflects the recent appreciation of the U.S. dollar versus most other currencies, with a balance attributable to continued business momentum driven by solid member growth and ad sales. Now, speaking of ad sales here, they don't disclose any numbers about how many of their subscribers are using the ad-supported version, though we hope to hear more in the earnings call. But they say the U.S. upfront is nearly complete. They've closed the vast majority of the deals with the major agencies. They say we're pleased with the results, which are consistent with our goal to roughly double ads revenue this year. And of course, we hope to learn more about the success of that ads business in the call, which starts at 4:45 p.m. Eastern. Back over to you.
Okay, Julia, thank you. Mark, want to get your reaction to that because doubling of ads revenue this year sounds exciting, but I also realize they're coming off of a low level, right?
They probably did about $800 million in ad revenue last year. So you're doubling it. You get to $1.5 to $2 billion. Hey, that's good. It's not great. You want 5 to 10 billion. And I think this company is certainly capable of delivering that. And I think they will over the next 3 years. I bet you they can keep that doubling or high double-digit growth rate for ad revenue for the next couple of years. So I think that's the real big bull case. But, you're still starting with a really small base. Look, this is a very good Netflixian print. They've got the strongest content slate out there. Our survey shows that consumers have consistently rated this as the #1 streaming service, and the lead seems to be widening. I know there's some wonderful hits on other networks like Love Island. That's popular in the Mahaney household. But outside of that, the content is really gapping up. The content leadership is really gapping up at Netflix. I think it will continue to do so. There's kind of a snowball to Netflix. The more subscribers they have, the more revenue they have, the more they can spend on content. The lead is going to widen. That's why you want to be long Netflix. And the free cash flow is starting to ramp up, too.
It's interesting because in your report ahead of this print, you did call out the fact that Netflix should benefit from a significant sequential FX tailwind. Julia just talked about that, too. Does that continue?
Probably, and I don't think you get a lot of credit from investors for, beating numbers based on FX. And that's why you don't have a big pop in the stock. But it's a subscription business. So you rarely get big pops in the revenues. Where you get the surprises is in the sub numbers. But of course, they don't disclose that anymore. So then where the real surprise comes in is in the operating income. And they keep showing this leverage. One question that I know is going to come up in that callback with management is, why did you only raise margins for the full year to 29.5% from 29%? That's not a huge increase, and you're running in the first half of the year well north of 30%. What are you going to be spending that money on in the back half of the year, or are you just being dramatically conservative? I don't know what the answer to that is, but I think that's the #1 question that I would think of going into that management call in a few minutes.
It's interesting to hear you say that because we've seen it in recent quarters where Netflix bottom line is growing at a faster rate than the top line. So perhaps getting back to that point.
Yeah, I think that's right. So why is that? Because it's a successful subscription business that can keep showing leverage against marketing costs. And then they've got this content flywheel, and they're going to keep raising their content spend. We're going to go from 17 to 18 to 19 to $20 billion a year. It's just that the revenue growth is growing faster than that content spend. So there's still inherent leverage in the model. But by the way, they have the right to dip in and aggressively go after some live event rights, sports rights, if those come up. And I would imagine they would look for that opportunity. That's probably what they're doing with their second half guidance. They probably want to give themselves the firepower to go after a big sports deal, live events deal, if it shows up. And if it doesn't, investors will see that margin flow through. It'll be higher than what they're guiding to.